Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically we had started our discussion over the types of bank, right? Over the types of banks. Okay, that's what we were discussing since last few lectures. All right. So basically in this lecture, we are going to continue with the same. All right. So far, we had completed the several types like the commercial banks. We have completed. Thereafter, we had completed the cooperative banks. Right. We had completed the rural banks or regional rural banks, you can call them. And fourth, we had completed the payment banks. Okay, so far we had completed all these banks. We had discussed them in detail. We had gone through various minor to major details regarding this thing. Okay, so I hope that you have revised them well so that you can connect the connections with the other banks also. Okay, so I hope that the things have been understood for you. Okay, if they are not, just watch the lecture again so that you can get the clear-cut idea again. All right. So with this note, let's start this lecture. So in this lecture, we are going to start with another important bank, which is known as the Small Finance Bank. Okay, we are going to start with the Small Finance Bank, which is in short also known as SFB. Okay, so please be attentive in this lecture. Let's start. So first part is the introduction. First is the introduction of the SFB. So the small finance banks are a specialized category of banks in India that were established to promote financial inclusion and provide banking services to small and marginalized customers, including individuals and businesses in rural and semi-urban areas. All right. So if we try to examine the definition, then we will notice some facts and figures written over here. The first is that they are of the specialized category. Okay, it means that they were established for some specific purpose. Okay, thereafter, when we go down in the definition, we will find out the specific purpose was financial inclusion and providing the banking services to the small and marginalized customers, which included the individuals and the businesses in rural and the semi-urban areas. All right. So this is the introduction of the small finance bank. Okay, you can get an idea about them. All right. If we move forward, then we have to start with the establishment and the regulatory framework. Okay, so the first is the SFBs. Small finance banks were introduced by the Reserve Bank of India in the year of 2015. Got it? As a new category of banks under the guidelines for licensing of small finance banks in the private sector. Okay, this word reminded me also of one thing. It was the year of November 2014. Okay, something was happened there, and thereafter we had the year of 2015. Something was happened during this time period. So my question is, what was actually happened? That's the question. Okay, so let's try to figure out the answer. The first thing, in the November 2014, RBI introduced the concept of payment banks. Okay. Thereafter, in the year of 2015, there was a guidelines for licensing payment banks. Okay, this was issued by the Reserve Bank of India. Okay, and what did it impact? It impacted that now the RBI formalized the existence of the payment bank, and now the payment banks were brought under the control of the Reserve Bank of India under the Banking Regulation Act 1949. Okay, similar thing happened with the small finance bank. It was the year of 2015. Okay. And the same thing, like the guidelines for licensing of small banks in private sector was introduced. Got it? Now, a small finance bank, we had got us, you can say, a clear-cut idea that they are very, very important. That's why the Reserve Bank of India has to issue a certain advisory for their establishment and regulatory framework. Okay. And by this also, we could understand that these were not a part of traditional banking. Okay. And they were brought under the control of RBI by accepting or by introducing them as a new bank category in 2015. Got it? Okay. So now we can say that the small finance banks were not a part of traditional banking prior to the 2015. In the year of 2015, they were brought under the control of Reserve Bank of India by accepting or introducing them as a new banking category. Okay. And how I can say that they were not a part of traditional banking? So if we go by the concept of the traditional banking, all right, if we go by the concept of the traditional banking, then the question is, what do you mean by the traditional banking? What is the exact meaning of the traditional banking? Okay, so as we had discussed many times, they had two main motives. The first is accepting the deposits. Got it? Second is granting the loans. Right? This is the traditional banking. All right. But how we can differentiate the small finance bank from the traditional banks by this criteria? Because these activities are also done by the small finance bank. Then how? How? The question is, they didn't have any specialized category. Didn't have any specialized category. Okay, but the small finance banks were established for a specific category which is known as the marginalized, you can say, segment of the population. Okay, so the basic activities of the SFBs and the traditional banks are same. Like they also accept a deposit, they also grant a loan. But because the traditional banks do not have any kind of special category, so that we could differentiate the traditional banks from the small finance bank. Got it? Now, if we move forward, second is the primary objective of SFBs is to provide banking services to underserved and excluded segments of the population. As I have told you many times, no one is more greedy than banks. Okay. This is the general motto in studies of the banking. Okay, no one is more greedy than a banks. All right. Banks always try to grant a loan at the high interest rate while they giving the interest on the saving accounts with low denomination. Okay, so that they could earn the access, and this access will be their profit. All right. So why, if they got the two persons, like the example I have given you, the first person could bear the 8% interest and the second person could bear the 12% interest. Okay. And if this is the bank and they had the two options, then the bank will always go with the 12% one. Okay. Now some of you could ask me, why not both? Bank could handle the both, could cater the both. Okay. So that they could earn the 12% as well as 8%. No, this is not possible. Why? Remember, whether it's financial, whether it's economical, whichever field study is it, remember, there are always a principle of scarcity or shortage or limited resources. Scarcity or shortage or limited resources. There is always the principle of this thing. Okay. So because banks are also belong to the economics as well as the financial sector. So remember, in the banks, the resources are also assumed to be scarce. It means that bank do not have an excessive amount of resources. Okay. They have the limited amount of resources which they have to spend rationally. All right. So if we go by this term, then we will find out the bank should always or will always prefer the person who could pay them 12% interest rate. Okay. Because right now this is the more cost, or you can say this is the opportunity cost by definition. Opportunity cost I had given you in the economics lectures. You can check them. All right. So now the question is, what should be done with 8% one? Like the bank has denied him to provide the loan. Okay. So who will provide the loan to 8% one? Okay. You can say the public sector banks could do this thing. The public sector banks could do this thing. Okay. But let me tell you one thing here also. India is lower upper middle class economy. Okay. So you can say in India, people generally do not earn as much as amount they could sustain their life in a luxurious way. Okay. So in India, people always tend to take the loans, credit facilities from the bank, whether on EMIs, whether on personal loans, car loans, homes loan, whatever you can say them. Okay. And then they purchase and consume the goods and services, which is good for the economy as well. All right. So you can say when we have this much population of the borrowers who want to borrow the money from the bank, then we could not say that the PSBs will be able to cater all the customers. Why? Because PSB is also having the limited amount of resources. You can say that they are being funded by the government, so the government could pay them more and more as much as the bank required, but this will impact the ratio of money supply in the economy. Okay, so that's why the PSBs could not be enumerated with a lot of money. Okay, so if we look at this, then we can say the PSBs also having a limited amount of resources. Okay, so they could not cater all the customers. In such a case, we required more and more players in the market who could help those who are not getting the loans from the traditional banks, because the traditional banks are preferring their high class customers. Okay, in such a cases, the small finance banks could be introduced. All right, got it? Okay, thereafter, SFBs are regulated and supervised by the Reserve Bank of India under the Banking Regulation Act 1949 and are subject to the guidelines and regulations. As we had discussed already, it was the year of 2015 when the book was issued named Guidelines for Licensing Small Banks in the Private Sector. Okay, under which various guidelines had been laid by the Reserve Bank of India for the SFBs, and thereafter the SFBs were brought under the control of BRA in 1949. Okay, and in the BRA, it was provided that the regulatory authority will be the Reserve Bank of India. So automatically, the Reserve Bank of India is the regulatory authority in case of the SFBs. Got it? Thereafter, if we talk about the ownership and the licensing segment, okay, so the ownership and licensing of the small finance banks in India are subject to a regulatory process governed by the Reserve Bank of India. Okay, as we know, in the 2015, the Reserve Bank of India released a separate report named as Guidelines for the Licensing of the Small Finance Banks in the Private Sector. Okay, in which the Reserve Bank of India provided a various provisions. Okay, and as per the provisions, the licensing and the ownership of the small finance banks could be defined. All right. So if we talk about the first concept, which is the ownership. So the question is, who could own the small finance banks? Okay. So small finance banks can be owned by various type of entities, including the first is the individual. All right. Individual entrepreneurs or groups of individuals can apply for an SFB license. These individuals are typically required to have significant financial resources, expertise in the banking and financial sector, and a clear business plan. Okay, so we can say single individual or a group of individual. Okay, both can apply for a SFB license and ownership. SFB license and ownership. Both are allowed, but on the conditions, if they are satisfying the regulatory authority, it means the Reserve Bank of India, in case of the financial sources, that they having the financial resources so that they could maintain the SFB for a long run. Second is the expertise in the banking and the financial sector. It means that whether this one or these ones, okay, they should be aware about the banking and the financial field, which means that they must be able to handle their bank effectively and efficiently. All right. If they are not capable of the banking and the financial services, they do not have expertise or knowledge in them, so they won't be able to sustain their bank for a long term. Okay, and this will not be a happy scenario for the economy and the country as well. Got it? Thereafter, the clear business plan. It means that what they are going to do, what is their motive and what is their plan. All the reports should be submitted to the Reserve Bank of India. Second was the NBFC, which is known as the non-banking financial companies. Okay, about NBFCs, we have a detailed discussion in the upcoming lectures. Till then, just take a little bit overview. Okay, existed NBFCs that meet the RBI's criteria can seek an SFB license. NBFCs must have a successful track record, minimum net worth as specified by the Reserve Bank of India, and a commitment to providing inclusive banking services. Okay, so if we talk about the NBFCs, then their definition stands for the non-banking financial companies. Okay, that's what their definition is. All right. In such a case, if we break down this definition, then the definition will be break down into two phases: non-banking and the financial company. Then how could we say this? That they are the not banking, still they are the financial company. All right. So by definition, we could say this: these organizations or companies actually provides credit lines, but do not accept the deposits. Okay, so NBFCs are basically those organizations or the companies which are allowed to provide the loans or credit lines to the customers, but they are not allowed to accept or take the deposit from their customers. All right, so in this scenario, it is just an overview which I had provided you about the NBFCs. We will have a discussion over it in the upcoming lectures. Got it? So basically, we can say if there is any existed NBFC, it means the NBFC which had already been installed or introduced. Okay, and if they are meeting the eligibility criteria by having the successful track record, it means that their track record should be very clear. Okay, should not be interrupted by any criminal offense or civil offense. Thereafter, minimum net worth as specified by the Reserve Bank of India to establish the payment banks. Thereafter, a commitment to providing inclusive banking services. It means that they must have their clear cut banking plan. Okay, if they do not have their clear cut banking plan, they won't be able to sustain the company for a long. And in such a scenario, the Reserve Bank of India will not allow them to open and own the small finance bank. Got it? Thereafter, the microfinance institutions, also known as MFIs. Okay, so the MFIs that meet the RBI's eligibility criteria, including the minimum net worth and compliance with the microfinance regulations, can apply for an SFB license. Okay, MFIs often have a strong focus on the financial inclusions, making them suitable candidates for SFB ownership. All right, so you can say NBFCs and MFIs. Okay, they both are providing the credit lines to the customers, but maybe or may not be they are not allowed to accept the deposits. In NBFCs, it is very clear that they are not allowed to accept the deposit from their customers. Okay, and second one we had is the MFIs. All right, now the question is that NBFCs are basically the larger groups. Okay, these are the larger entities which focus on the big corporations, governments, and large entities. All right, whereas NBFCs are basically the smaller or basically the micro groups. Okay, and they are generally dealing with the small type of customer, small type of entrepreneur. Okay, small areas and dealings. Got it? That's why they are known as the microfinance institutions. All right, so in case of the MFIs, if they meet the eligibility criteria, they have the minimum net worth, and they also complies with the microfinance regulations, then they could apply for a license. Thereafter, we have the other private entities. Private sector entities such as companies and organizations can also apply for an SFB license if they meet the RBI's criteria, including minimum capital. Entities must demonstrate their ability to adhere the regulatory guidelines and serve the financial needs of the undeserved population. Okay, so if we try to figure it out, then from the starting, the eligibility criteria must have a knowledge or experience in banking on financial fields. All right, but in the case of other entities, it is not required that they must have a knowledge or the experience. Okay, but simply we can say they must be capable of holding the SFB for a long time. Okay, so this is the basic difference. All the other factors either belong to the field, okay, or already established in the field. Whereas other private entities which are allowed to own the SFBs, the first step is that they have to satisfy the Reserve Bank of India that they having the capability to hold the bank for a long. Okay, whether by appointing the staff, whether by taking the advice, whether by making a clear-cut plan, whatever they have to do, but they have to satisfy the Reserve Bank of India that they are capable to do so. Then only they will be allowed to holding a small finance bank. Got it? This is another criteria. Now, if we talk about the minimum capital requirement ratio, okay. So if we talk about the minimum capital requirement, like how much is the minimum amount required for a small finance banks to be established or be operated, okay. So in case of the small finance bank, the minimum capital must be stand at rupees 100 crores. Okay, so we can say if this person or if these person, he wants to establish a SFB, they want to establish a SFB. Okay, in both the cases, they must have at least rupees 100 crores. Okay, then only they are allowed to apply for the licensing process or the ownership. Okay, this is the first clause. Second clause is that within the time period of 5 years since the bank was established, okay, minimum capital must be raised from rupees 100 to 200 crores. All right. So we can say if this person or if these people or persons, they want to operate the small finance bank. All right. So suppose in 2001, they got the commencement approval by obtaining the rupees 100 crores. This is the minimum capital. Okay. So within the 5 years, it means before reaching the 2006 or till 2005, their minimum capital must be raised from rupees 100 to 200 crores. Okay. So this is the second clause. The first clause in the minimum capital is that this should be rupees 100 crores. The second clause is that they must be reached at 200 crores within the 5 years after the commencement of the business. All right. Remember this thing. But this is determined by the RBI and may be subject to change over time. It means that it is not fixed. And it is basically tentative. Not fixed and the tentative amount. Got it? Thereafter, the minimum capital requirement is essential to ensure the financial stability and resilience of the SFB, enabling it to absorb potential losses and meet its obligation to depositors and the other stakeholders. So we can say if the SFB established, okay, suppose they had granted the loans and takers were defaulted. If this is the condition, all right, like XYZ was the SFB, they granted the loans, but the takers were defaulted because these are generally the marginalized workers, segments, and the small entrepreneurs. Okay, in such a case, their assets are lost. Assets are lost. Got it? But their liabilities are still waiting. It means that doesn't matter whether they had lost their loans and the outstanding, but still they are liable to the backend. It means that they are liable to the people who had deposited their money with them. Alright? In such a scenario, the XYZ had to pay back the amount which had been deposited with them. But if they are not able to recover the amount from the persons who had taken them, in case of this, the bank will declare it as a insolvent or bankrupt. Got it? So to handle such kind of situations, it is mandatory that their initial paid up capital or the minimum paid up capital must be rupees 100 crores. Okay. In the private banks, how much it was? Rupees 500 crores. Right? Okay. Now you can say, why? Why this much of difference is there? The difference is there because the private banks do not have any generalized category. Okay. They are dealing with everyone. However, it depends upon them that whether they are preferring the marginalized segment or not, but they are dealing with them. Okay. It could not be happen that someone who is belong to the marginalized section of the society, he go to the branch of the bank and the bank say, go out, you are not belong to our society. This will never happen. All right. However, it could happen that the bank will deny to provide the loan to him. Okay. But at least they will attempt it. Got it? So that's why we can say in the private sector bank, there is no generalized category. All right. They are dealing with each and everyone. That's why they required a high amount of initial paid up capital. But in case of the small finance banks, they are dealing with the specific section of the society. Okay. So we can say the section they are dealing with generally do not take heavy loans. Got it? It means that the banks, the small finance banks, which dealing with the people, these people do not take the heavy loans because they are the small and the marginalized section of society. All right. That's why even 100 crores, it could be possible that the small finance bank could sustain itself in case of defaulted of the loans payment from the outsiders. All right. So remember this thing. The minimum capital requirement is essential to ensure the financial stability and reliance of the SFB, enabling it to absorb the potential losses and meet its obligation to the depositors and stakeholders. Okay, so they could accept the loss or observe the loss, and even they could discharge their obligation towards the depositors and the other stakeholders. All right, applicants must demonstrate their financial capability by maintaining the required minimum capital level throughout their operations. All right, as I had told you, suppose if the bank was established in 2001, so it could be granted the power of licensing and operations if the bank is capable to maintain rupees 100 crores with itself. All right, but within the time period of 5 years after the commencement of the business, all right, this capital must be raised from 100 crores to rupees 200 crores. All right. This shows that the owners, promoters, or basically you can say the stakeholders of the banks are able to not only sustain the bank but also grow the bank and could maintain the required minimum capital level throughout their operations. All right. So that in case of the default from the loan taker, the bank could absorb the losses and discharge the liabilities towards their stakeholders. All right. After ownership licensing, now we have the licensing process. Okay. So the process of obtaining an SFB license involves separate steps. Like the one step is application submission. Prospective SFB owners submit a formal application to the RBI accompanied by the detailed documentation and the financial information. Application outlines their proposed business plan, ownership structure, governance framework, and the compliance with regulatory guidelines. Okay, just try to understand it. First case is a case of individual. Okay, if the individual wants to open the small finance bank XYZ, in such a case, he is required to formulate a formal letter of application to whom? To the Reserve Bank of India. Alright. Thereafter, the Reserve Bank of India will examine the capital requirement, like how much capital he has. Okay. Thereafter, they will examine the business plan, like for why he is opening it. Okay. Thereafter, the Reserve Bank of India will examine the organizational structure. Alright. And other was governance framework and his understanding of regulations. Regulation understandings. Okay. So these were some of the major points which will be enumerated on the application. Okay. Like whether he is having 100 crores or not. What is the business plan? Organizational structure means, listen, this person by himself is not able to obtain the XYZ. Okay. He could not be the accountant. He could not be the cashier. He could not be the manager. He could not be the tech team. He could not be the customer support. Okay. He could be the owner. He could manage them, but he could not play a role of each and everyone. Alright. It means that he has to hire the people from the outside. And if he is doing this, these people must be divided in the group known as the division of work. Right? He has to make these works. Okay? Got it? He has to do this kind of things. Right? Thereafter, this is basically defines the organizational structure. Like who will be the manager, who will be the team lead, who will be the technical team supporter, whatever it is. Okay. Thereafter, the regulatory understandings. Okay. It means that whether he is having the knowledge of the field or not, and whether he is able to maintain the compliance with the regulatory provisions regarding by the Reserve Bank of India. Alright. It is a case of the individual. Similar things happen with the group and the other private entities. Group or other private entities. Okay. Here I am involving the other entities, like you can say the NBFCs, the MFIs, and even the private companies. Alright. And the group of people. Okay. So in case of them, also the requirements will be the same. It means capital requirements. Okay. Organizational structure. Alright. Thereafter, regulations knowledge. Okay. Purpose, business plan. These all things should be maintained or should be mentioned on the application form. Got it? It is the first step. Second step is that regulatory assessment. Okay. RBI reviews the application because it is the regulatory authority in this case. Assess the applicant's eligibility and evaluates their financial standing, track record, and regulatory compliance. A thorough due diligence process is conducted to ensure that the applicants meet the criteria outlined in the guidelines for licensing of small finance banks in the private sector. Okay. once the application submitted to the Reserve Bank of India. Okay, here begins the second step. It means that the Reserve Bank of India assesses the applicant's eligibility, okay, evaluate their financial standing and their past track record and their regulatory compliance knowledge. Okay, thereafter, diligence process. It means that a proper organizational investigation has been conducted to ensure that the applicants meets the criteria outlined in the guidelines for licensing of small finance banks in the private sector. It means all the criteria mentioned in that particular document should be met up in case of applying for the license. All right. Thereafter, we have the approval. It is the third step. The first is the application forwardness. Second one is the assessment. Third one is the approval. Upon successful completion of the evaluation and the approval process, RBI grants the applicant an SBI license, allowing them to commence banking operations. It means that once the RBI satisfied after doing the assessment and the RBI finds out that the applicant who had submitted the application is able and the capable to hold the small finance bank under him, then the RBI grants the applicant an license and allowing them to commence the banking operation. It means that if a person who was trying to establish the bank is able to satisfy the RBI, then they could establish its bank called XYZ. Okay, so this is the approval case. Thereafter, regulatory oversight. Okay, it is the fourth step. Once licensed, SBI are subject to stringent regulatory oversight by the Reserve Bank of India, must comply with the various prudential norms, including capital adequacy requirements, assets classification, liquidity management, and the governance standard. All right, it means that if this person who wants to open the XYZ, okay, he gets the license from the Reserve Bank of India. In such a scenario, he has to maintain with each and every guidelines issued by the Reserve Bank of India. All right, they must comply with various prudential norms, including capital adequacy requirements, assets classification, liquidity management, and the governance standards. Okay, this is the regulatory oversight phenomenon. Okay, the RBI conducts regular inspection, audits, and supervisory assessment to monitor the SFB's operationals and ensure continued compliance with the regulatory guidelines. All right, it means that now when it puts under the control of the RBI starts giving the treatment like the other banks by conducting the inspections, external audits, supervisory assessments, and monitor the SFB's operations and ensure that continued compliance with the regulatory guidelines. Okay. So students, basically in this lecture, we have finished with the some facts of the small finance banks. Okay. We have covered the licensing and the ownership process. In the next lecture, we will continue with the small finance bank, but we will look upon the other facts and figures regarding with the same topic. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and thank you.